Why are mortgage rates rising just as the spring housing market finally starts showing signs of life? That is the puzzle shaping housing right now. A new Federal Reserve chair took office this week, but the market did not greet that change with cheaper mortgages. Rates moved the other way. The spine of this story comes from Realtor.com's May 22nd housing update. Its core message is simple. Conditions are still hard, but they are no longer uniformly bad. Freddie Mac says the average 30-year fixed mortgage rate jumped to 6.51% in the week ending May 21st. That was up 15 basis points in just 1 week. Even so, that rate was still lower than a year earlier. So buyers are dealing with pressure, but not the worst conditions of the last several years. The article ties that jump to hotter inflation pressure and wider geopolitical uncertainty. The broad takeaway is that bond markets still care more about inflation risk than leadership changes. That matters because mortgage rates are driven less by headlines around the Fed chair and more by inflation expectations, Treasury yields, and investor confidence. The piece argues that tension between the White House and the Fed may actually help. If markets believe the Fed stays independent, long-term borrowing costs can settle over time. Now here is where the spring market gets interesting. Sales have stayed subdued, but the market is showing early signs of thaw instead of freeze. The National Association of Realtors reported that its pending home sales index rose 1.4% in April. It was also up 3.2% from a year earlier. Pending sales matter because they track signed contracts, not final closings. Think of them as a weather radar for future sales, not the rain already falling. And there is a second data point that strengthens that story. Realtor.com's own Spring Progress Report says newly pending listings in April were up 4.5% from a year earlier, after a 2.9% annual gain in March. For the first time since the post-2022 rate shock reset, contract signings are running consistently above the tight range that defined the last 3 spring seasons. That makes this rebound modest, but more credible. It is not just a 1-week mood swing. It is showing up across multiple measures of buyer activity. Regionally, the strongest gains came in the South, followed by the West and Midwest. The Northeast lagged overall, though some metros still showed clear momentum. Realtor.com also found that 34 of the 50 largest metros have seen more contract signings so far in 2026 than a year earlier, and 31 of 50 have seen more new listings. In other words, this is still a fragmented market, but the thaw is broad enough to notice. Improvement is real, but uneven. The strongest common factor was not optimism, it was seller behavior. Markets with more realistic starting prices saw fewer later price cuts and more homes going under contract. That is a sharp lesson for sellers. In this market, pricing high and waiting is often a tax on time. Pricing right from the start can pull buyers back in. The affordability picture is still rough. Realtor.com and the Realtors Trade Group estimate buyers have only about 75% of the access they would have in a well-aligned market. That means the market remains structurally tight, especially for entry-level and middle-income households. In plain English, many buyers still cannot reach the homes they need. The article also points to a notable shift in down payments this spring. They moved lower after a long stretch of rising, which could help some households re-enter the market. And the scale of that move is worth pausing on. Realtor.com's latest down payment report says the median down payment fell to $23,400 in the first quarter of 2026, or 12.8% of the purchase price. That was down 19% from a year earlier and the lowest level in 4 years. One reason is softer pricing in some areas. Another is the growing role of government-backed loans with lower cash requirements, especially loans backed by the Veterans Administration, Federal Housing Administration, and the Department of Agriculture. That explanation holds up. The Department of Veterans Affairs says its home loan program guaranteed more than 500,000 loans in fiscal year 2025, while continuing to offer eligible borrowers purchase options that can be more favorable than many conventional alternatives. The Department of Agriculture still says its single-family housing guaranteed loan program supports 100% financing for eligible rural buyers, meaning no down payment for those who qualify. Housing and Urban Development also shows why Federal Housing Administration lending matters here. In fiscal year 2025, more than 83% of FHA purchase endorsements went to first-time buyers. That helps explain why lower down payments matter so much right now. They do not solve the monthly payment problem created by high rates, but they do reduce the upfront cash hurdle at the exact moment when many buyers are stretched on both fronts. There is another reason this shift may be showing up now. National home prices are still rising, but far more slowly than during the frenzy years. The Federal Housing Finance Agency said U.S. house prices in the first quarter of 2026 were up just 1.7% from a year earlier. Slower price growth does not make homes cheap, but it can take some pressure off the cash buyers need at closing. Lower down payments are one of the few active release valves in a market where monthly payments still do most of the damage. Supply is improving, but not in a clean, straight line. That is another reason this market feels better in spots without feeling easy overall. The article says new listings and contract signings both improved this spring. That suggests more sellers are participating and more buyers are acting when the price feels believable. Realtor.com's broader spring report adds useful texture here. It says 2026 is running just ahead of 2025 on new listings through April, making this the strongest year for fresh listing activity since 2022. Supply has recovered faster than demand since the trough, but the gap is narrowing as contract signings start to outpace listing growth. On construction, the pattern is mixed. Realtor.com reports permits were roughly flat from a year earlier, starts rose, and completions slipped. Federal construction data tell a similar story. In the April 2026 release, the Census Bureau and HUD said building permits were at a seasonally adjusted annual rate of 1,442,000, basically flat from a year earlier. Housing starts were up 4.6% from April 2025, and completions were down 2%. That helps explain why the market still feels undersupplied, even when builders are active. Future intent is not collapsing. Current building is still happening, but finished homes are not arriving fast enough. That is especially true at the lower end of the market. The article stresses that the biggest construction need remains homes for entry-level and middle-income buyers. There is better news for renters. More multifamily resilience means rental supply has held up better, which can ease rent pressure even if it does not fix the for-sale market. That matters because multifamily has been carrying more of the construction burden lately. In the same April federal data, the 5 units or more category remained a major contributor to activity. So for buyers, the spring story is not relief. It is selective opportunity. More choice in some places, better negotiating room in some listings, but still no broad affordability breakthrough. The article ends with a luxury comparison between Providence and Salt Lake City. That may sound niche, but it makes an important point about the whole market. Luxury does not mean one national template. In Providence, it leans older, tighter, and more established. In Salt Lake City, it looks newer, more expansive, and more shaped by recent construction. That contrast matters beyond luxury buyers. It is a reminder that local structure now matters more than national mood. One market can loosen while another stays stubbornly constrained. So what should you actually take from all this? Mortgage rates are still the biggest break, but pricing discipline is becoming the biggest unlock. If inflation cools and rates stabilize, these green shoots could turn into a stronger summer. If not, the market may keep grinding forward one realistic listing at a time.